The S&P 500 as of today has returned 238% over 10 years, including dividends reinvested. But have you ever heard the phrase past performance does not guarantee future returns? I think that phrase is likely to hold true, especially when we consider that stock price is greatly outpacing earnings, which we can see through the current PE ratio of the S&P 500 versus its PE ratio over the past 50 years, which is currently at a trailing PE of 30.3, and each time valuations were this high in the past, they were shortly followed by a dramatic plummet in price, which we can see through the rise in valuation levels preceding the crash of 2020, again in late 2008 with the great financial crisis, and preceding the dot-com bubble, which burst around 2001, and just before the dot-com bubble too, although valuations still rose dramatically before they had their impending fall, so in that sense there may be some runway before the cliff disappears beneath the current market. If you're wondering why I didn't use the maximum available time frame, that's because the S&P 500 index was founded in 1957. And websites use different methods to backfill data before the index was actually created. Another metric that I use personally to determine value when buying stocks is the current dividend yield of a company in comparison to its own 5 and 10-year dividend yield history. By current dividend yield, the S&P 500 is vastly overvalued with a current yield of just 1.2%, which is a 10-year low, again indicating overvaluation. This ability of being able to see the dividend yield of an ETF over a 10-year period is a feature I love about seeking alpha, and if you also see value in this data, I have a link below which will give you a $30 discount off the premium membership and a 7-day free trial. The next all-important metric for determining relative value in the S&P 500 can be seen through the standard deviation channel, which is a statistical tool that determines the average price over a given period, shown with this center yellow line. Here we have the first S&P 500 ETF SPY since inception in 1993, and the current price level that we're at has never been so far away from the average price over this entire period. And each time price floated away from the mean like it did in the past, this resulted in years of negative returns had you invested at the top of the cycle, like in 2022, which took about 2 years to return to this price level. Or had you invested at the top of the market in 2000, you would have had about 13 years of negative returns. So when you hear people talking about the S&P 500 as if it only goes up, that's not the case except over long periods of time. Although had you invested at the top of the market in March of 2000, you'd still be up by about 276% in price appreciation, assuming you sold at the top of this market and were able to hold for nearly a quarter century, which is why people say things like it's about time in the market, not timing the market. This is why it's so critical to know how much time you have until you need money back from stock market returns, and why you may benefit from a portfolio not solely based on capital appreciation. In considering the current yield of the S&P 500 at 1.2% and a 10-year dividend compound annual growth rate of just 6.3%, this shouldn't be considered an income investment. The last metric for determining relative value that we see on this chart is the relative strength index graphed at the bottom. This metric varies between signal and noise with the S&P 500. Nonetheless, it shows that the market is at the high end of its historical range, with the RSI currently at 71.2, and the last time the RSI was around this level, it wasn't long before price reversed. So if we consider all four metrics, the historically high PE ratio, the 10-year low dividend yield, and the improbably high price level based on the standard deviation, in correlation with the RSI, the market looks ripe for a serious price reversal. But what can we do with this information? I think the most critical plan of action is to know your investment time frame and not to sell at the bottom. Or you could invest for income with quality dividend ETFs like SCHD rather than banking on price appreciation. And if you're interested in stocks that will likely outperform the market over the coming years, check out this video covering AutoZone.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.